The Warehouse Group has hit reset on its strategy as it battles to survive amid competition from offshore retailers. Why its chairwoman is committed to seeing it through.
We've done the mea culpas in terms of what we've got wrong, and there's a lot of it.
Did you ever consider your own position?
Absolutely. And, you know, the easiest thing in the world to do would be to bail.
Get to the warehouse, where everyone gets a bargain.
The Warehouse Group's own share price is going for a bargain these days, after posting its first annual net loss in its 42-year history. Its stock is now priced around $1, from its peak of more than $7. The retailer has a long history, started by Stephen Tindall in 1982. It expanded its Redshed operation to include warehouse stationery and Noel Leeming. It now has more than 200 stores nationwide. Under the former CEO, Nick Grayston, it put in place an ecosystem strategy, adding on other businesses like Torpedo7 and launching an online offering, themarket.com. That's where it all went wrong. In the past 6 months, it's done a U-turn, selling Torpedo7 for $1 and closing down the market indefinitely. Grayston left the company and Tindall tried to take back control, armed with a private equity firm's finances. But their circa $500 million bid failed to get shareholder support. The board is now focused on getting the company back to its core, fighting to win back market share that's shifted to competitors like Kmart. Chairwoman Joan Withers is leading that reset. She's been with the Warehouse for 8 years. But as she explains in this interview, this effort will likely be her last. Well, Dame Joan Withers, thank you so much for doing this. I really appreciate it. We've been meaning to do this for a while, haven't we?
We have.
And then the takeover
I'm
happened.
so glad we're finally doing it.
You and I both. Thank you so much for having us here today. Look, we are going to talk about where you and the board of the Warehouse Group are taking this company next. But I think first we should acknowledge what's occurred and sort of how we got here. At what point did you realise that the Warehouse Group had sort of lost its way?
Yeah, I think, you know, for those of us who are directors who've been on the board for a while, it's been an interesting journey. And you might remember that only sort of 3 or 4 years ago, the Warehouse got the Deloitte Most Improved Company of the Year award. So it's been an interesting transition over the last couple of years as we went through COVID. We've had some record performances in terms of both revenue and bottom line. 2021 post-COVID obviously was, you know, an aberration, but a very good aberration. But what we've come to understand, particularly in the last 6 to 12 months particularly, is that, you know, the focus that we had on an ecosystem meant that we weren't focusing on the bread and butter parts of the business that were so critically important.
And that's where you came to the conclusion to sell some of them off and make some changes?
Yeah, I think, you know, when you look back on the strategy for both Torpedo7 and the market, Torpedo7 predates my time on the board in terms of the acquisition, but that was a business that you could see had a level of compatibility with what the Warehouse was doing. We got it to a situation where it was slightly profitable and then slightly unprofitable, then fell off a cliff in FY23. So that was a $20-odd million drag on the bottom line. The market, you know, we took that strategy at a time that we thought having a broad appeal, omni-channel presence platform was existentially important to us. We saw clear and present danger with Amazon in Australia coming over here. We thought being able to offer our customers the Warehouse's goods along with third-party goods was a way to go. We developed a plan in terms of where we anticipated we would get to break even, and when we didn't meet those milestones, you know, we were looking to break even in FY23. Again, we've had to make a very, very hard decision as far as that's concerned, because again in FY23, $20-odd million operating loss. So, you know, if you had limitless funds and limitless capacity, you might persevere, but certainly with where we were at, there was no alternative other than to take those very hard decisions.
You told me that the Warehouse Group and the board have gone through a bit of a reflection period. Talk me through that. What have you and the board reflected on, and what's the conclusion you came to as to ultimately why those moves didn't work?
Yeah, I think the individual decisions you make quite pragmatically and philosophically, given where you are at any point in time. I think the wider reflection is what could have we done, what should have we have done earlier. I think that's the acid test, and we're still individually and collectively reflecting on that, and I think that's a very appropriate process, because the board is obviously accountable to shareholders for shareholder value. We can't do everything, we can't reach in beyond the CEO and get involved in the execution and the operational issues, but we do look at it and say, what could or should we have done differently if we had our time over again?
Obviously some leadership changes were made. Within that reflection period, did you ever consider your own position?
Absolutely. And the easiest thing in the world to do would be to bail. I signalled when I stood for re-election 2 years ago this would be my last term. I think either bailing or throwing directors overboard at this point in time would not be in the best interests of the company. Obviously we've got JJ now dedicated to the group CEO role, and he's an executive director. We're going through a replacement process. We've had some takeover activity in the last few months. So I don't think now is the time for me to go. But I think again, it's something that we all reflect on and say, what could or should we have done differently?
In this economic environment, the warehouse really should have thrived, right? Because in a high cost of living environment, this is a cheaper retail offering. But rather, New Zealand consumers have gone and queued up at Kmart. They've turned to Temu online in droves. So what are you going to do to win those customers back and have this retailer's products resonate with them once more?
Yeah, well, we're doing it. And I think, making those two big moves in terms of getting rid of, effectively in FY23, $44 million worth of operating profit drag has put us in a much better position. But the focus on the stores and the products and our customers is now first and foremost. And, we had an ecosystem strategy for valid reasons. It probably distracted us from some of the core things that we should have been doing better for our customers. So getting that product offering right, making sure that we're getting the stuff that we need in the right place at the right time, making sure that we've got the mix right, because obviously, we've had massive growth in terms of grocery. We admit publicly we've lost some market share in both homeware and apparel, but we're fighting now to get that back. And even in the last few weeks, with a renewed focus, some of the new product now landing, we are starting to see our market share figures start climb back up again. That's only a very small point in time, and there's a hell of a lot of wood to chop, but we know by focusing on the right things that we will see a difference. And Kiwis love the warehouse. We had the Maori Language Week Kia Kaha offering in our stores a couple of Saturdays ago. I went down to Pukekohe to try and get an outfit and was told, well, pick through what's left, and that was at 9:15 in the morning. So we sold out virtually everywhere. So we know that Kiwis want us to do better, and we're going to fulfil that for them.
So in your eyes then, it's most definitely not a reputation issue with the brand at all, it's more just a product mix that you've got to fix?
I think Kiwis want us to do well. They love the brand. We've got Barbie painted over the front of Albany at the moment. So when we do get things right, we get a fabulous response. We've just got to do things right 100% of the time.
You mentioned a few of those product categories, and I want to talk to you about how you think about margin mix in this environment, because as you said, with grocery, it's making up a larger portion of your sales, and a lot of noise has been made about the warehouse's sort of bigger move into grocery and perhaps the changes that it could make in that industry. But you don't seem to be really going harder on that. Is that a value over volume sort of question that you're battling with?
I think it's about getting the mix right. And, grocery is part of our offering. And I think what we've done there in terms of some of our home brands has been really good. And again, going back to Kiwis loving our offering, as you saw with Sanitarium when we had the issues with supply 6 to 9 months ago, Kiwis were there in droves trying to support us. Cheaper butter going back a little bit further. But we've got to get the mix of our segments right. Otherwise, we can't do what we need to do. And certainly homeware and apparel, I don't think our offering has been up to scratch, and that's what the team are now working on.
So you view that category specifically as kind of the biggest margin gain opportunity?
Homeware is one, apparel's the other, definitely.
How do you know from the board level when you set a strategy like this one that you've communicated to us now, how do you know it's right? Do you test it along the way?
Yeah, certainly we get very granular reporting as to what's happening. So I think we get very good insights as to what's working and what's not at a store and product level. It's much harder when you're doing something that's a new initiative, e.g. the market, for example. Much harder to understand on a week-by-week basis exactly what's happening. So this is the stuff that we should absolutely be superb at.
Are you going to be a bit more ruthless on checking that along the way, given that the former strategy, as you've admitted, kind of went on too long and wasn't fixed early enough? Are there going to be sort of more checkpoints along the way with
Well, I
this one?
think that the big difference now, Madison, is we've invested over the last 5 years $130 million on replacing legacy systems. So those are giving us much better capability. So our ERPFI, which is our finance and inventory system, has only gone live in the last 3 months. We've got master data management. We've got much better visibility over those sorts of things now than we had before. So that will certainly help us.
I'm an optimist, but there are risks to every strategy. What would you say are the biggest risks to this one going forward?
Biggest risk is the economic environment in New Zealand. We are not alone. We've done the mea culpas in terms of what we've got wrong, and there's a lot of it. But you've got to say, you know, I saw KMD's result last week. The first 8 weeks of this financial year, they're down 23% year on year. So it's has been a very tough operating environment. And we were all hoping that with one OCR cut and hopefully maybe a 50 basis point cut coming up, Kiwis will loosen the purse strings a little bit. Some of their discretionary spending will look better than it has, and certainly in the last 12 or 18 months, and we'll certainly benefit from that.
Yeah, it's tough, right? Because you can only control the controllables. And at the moment in this economic environment, there is so much still outside of company and board's control. We've seen boards be brutalised quite a bit. To name a few, Ryman Healthcare, Fletcher Building, the CEO and the chair of that company both left. If that's the symptom, what do you think the cause of that erosion in shareholder value across the market, broadly speaking, has been, if not just economic environment?
Well, I'm not going to comment on other companies and what they've done right or wrong. I'll comment on the Warehouse Group. And I think that's part of the challenge, is disaggregating what is economic, what's the economic environment doing, what are your strategic missteps, and what is execution, which is the purview of management, obviously. And it's actually understanding and trying to calibrate what did we get wrong. And like I've said, we fessed up to a hell of a lot. But you've got to have those, you've got to be able to look at it and say, what else is out there that's caused this? What are the controllables? What are the uncontrollables? I think the great thing in New Zealand, we've got a great investor community who really do look at this stuff, and write good interpretations of what they're seeing.
On that point, actually, it's not even just winning over consumers, is it? I mean, you sort of have to win back investor trust and credibility among them too. You're confident you can do that at the same time?
Do our very best, yeah. Again, I think their willingness, they've stuck with us. For the ones who are still there on the register, they've really, been through the hard times, and to say they're patient is an understatement, but again, it's a situation where we're going to do the very best we can to improve our shareholder returns. Again, it's been erratic. If you look at the last few years leading up to COVID, we had some record years, but it's been tough the last few years.
Among all of this, too, you've also had takeover interest that from the board level you've also had to deal with. How much of a distraction has that been while you're trying to go through all of this at the same time?
Well, as it turned out, it wasn't that much of a distraction, because we had a critical shareholder who was not prepared to give the proposal support. And at that level, there's nothing you can do with a scheme of arrangement, as you know, it's impossible. So, I'm sort of become a little bit familiar because I'm on the Origin board in Australia, and we went through the attempted takeover last year. Sky, we were public about the fact we had an MBIO which didn't progress because it wasn't, at an acceptable level. So this one was probably a bit more straightforward than many are.
I mean, I know that one was sort of battered off quite quickly, but do you think that among all of this there might be some more offers thrown your way?
No idea.
What would you say to them if anybody was thinking about it?
Well, I think it comes down to when you've got a 20% shareholder, it's really, if there are, in any scenario, if there's one or two classes, it's still going to be a block. So it really comes down to what their perception of value is and what their long-term strategic interest is.
How long do you think this will take, Joan, at the Warehouse Group until you're seeing some of those record high years, or at least better years, that aren't loss-making?
Yeah, look, I think, again, the caveat is the economic environment, and I am a lot more optimistic than I was 12 months ago. So for me personally, it would be nice, in 13 months' time, 13 and a half months' time, when I stand aside from the Warehouse board, that we're in a much, much better position.
Perhaps we can do another interview just before you go. Dame Joan Withers, thank you so much for doing this. I really appreciate it.
Thanks, Madison.
Thanks for watching Markets with Madison. If you enjoyed this interview, please hit the like and subscribe buttons below. I do all of the research for these episodes myself, so your support means a lot. I always love to hear your feedback and ideas, so please drop any thoughts in the comments below. Now go put your money to work.